Are you a cryptocurrency investor or maybe a business accepting cryptocurrency and you're attempting to manage your cryptocurrency accounting? You're probably quickly realizing that the complexity around accounting for digital assets can increase very quickly. And I hate to be the bearer of bad news, but that complexity is going to continue to increase now that we have the final broker regulations and specifically revenue procedure 2024 28. That's what I want to go over in this video today. How are you properly going to do your accounting and apply accurate cost basis calculations given the new guidance that we've received from the IRS? For many of you, this may mean that you need to go back and correct some of your prior accounting to get your cost basis information accurate for future allocation purposes. So this video pertains to anyone that is transacting in crypto and doing their cryptocurrency accounting. So let's get right into it. So as we've already stated, there's a lot of complexity in general to doing your cryptocurrency accounting. And of course, that's outside of the scope of this video. I have many other videos where we go over due diligence steps and steps to take in your overall accounting to make sure that you have data integrity and due diligence within your accounting system. What I want to talk about today is Revenue Procedure 2024 28, which the IRS has used to further clarify the acceptable accounting methods that are allowed for cryptocurrency. Before we had Revenue Procedure 2024 28, taxpayers, CPAs, tax professionals were all relying on the previous guidance, mainly the Q&As that the IRS provided related to cost basis tracking. What this resulted in was a lot of firms, a lot of taxpayers doing their accounting on what's called a universal basis, meaning if you have accounts and transactions across several exchanges and several non-custodial wallets, what a lot of firms and a lot of taxpayers and a lot of softwares were doing was you could take all this information, input it into the software, and then it's all going to get jumbled together and produce you the most accurate gain or loss calculation, regardless of your actual flow of funds on chain. Meaning maybe you purchased Bitcoin across Ethereum or across Kraken, Coinbase, and several other exchanges, and then you went and you sold it on one of these exchanges. In most cases, what I've seen a lot of people do was in the past, even if you bought and sold that Bitcoin on Coinbase, if there was a higher cost basis Bitcoin purchase on Kraken, they'll count that cost basis towards the sale on Coinbase, even if there was no transfer complete. And what I'm describing here is a lot of times what you would hear people say, what people are doing if you heard them say they were doing HIFA. Basically just taking the biggest cost and the lowest amount of proceeds and combining them together to get the best tax result. So from my perspective and from my firm's perspective, we never have taken this approach. We've always taken an account-based approach because it seemed more logical. It seemed like a better interpretation of the existing rules. And overall, it just seemed like a more reasonable perspective than jumbling this all together. But many people were doing this universal accounting method. And now what the IRS is requiring is that the universal accounting method is no longer permitted. You're going to have to track everything on an account-based method, wallet by wallet, exchange by exchange. Meaning, if you purchase one asset on XYZ exchange and you transfer it over to that other XYZ exchange, your accounting has to track the purchase, the transfer, and the fact that it's on the last exchange that you transferred it to. Or if you transfer to a wallet, you have to track that it's there. And you need to track your basis by wallet, by exchange, and this needs to be accurate. Why does this need to be accurate? Because it's going to largely impact your gain or loss calculations. And it's going to prevent people from taking this approach where they enter everything into his tax software, they choose HIFO, they get the best tax outcome, even if that tax outcome doesn't truly reflect their on-chain activity and their audit trail is not really painting a picture of what happened throughout the year. So that is the first thing. You need to be tracking everything on an account basis, and these basis calculations need to be accurate. And that is a huge issue I just see in general with people's cryptocurrency accounting. Secondly, people were applying spec ID and oftentimes just blanket selecting HIFO or other advantageous accounting method selections across the board for their portfolio. This also is now not going to be permitted for Revenue Procedure 2024-28. You're going to have to, at the time of sale, be able to identify the asset that is being sold. You're going to have standing orders with your brokers, and you're going to have a reasonable method for tracking the basis in any non-custodial wallets. One recommendation from my firm and something that we've been following for quite some time is if you do have separate tax lots of a given asset, it may make sense to segregate them out into separate cold wallets by tax lot. That makes it very easy for us to build an audit trail and to track and trace those transactions and assign the right tax lots to any given transaction or sale. So you may be listening to this right now and realize that you haven't been keeping track of your transactions on an account by account basis. You've been taking this universal approach and maybe even have been applying spec ID or HIFO just after the fact when you're doing your accounting, not at the time of sale. That's going to have to change in the future. And according to Revenue Procedure 2024-28, this is going to have to change by 2025. So there are transitional relief measures that are built into this revenue procedure, and that's going to allow taxpayers to allocate their unused basis to individual assets, and then that unused basis will get allocated to subsequent sales within that account in the future. So there are certain conditions that taxpayers are going to have to meet if they're going to want to be able to apply that transitional relief. And it's very important that taxpayers are working towards doing that now, because the deadline is by January 1st, 2025, and that is going to come very quickly, and there may need to be a lot of accounting work done to get to that point. Now, you as the taxpayer are going to have to maintain adequate records to support your basis calculations. And when you're allocating the unused basis to these individual digital assets, you're going to have to do it in a specific manner according to Revenue Procedure 2024-28. Now, it does also say in this revenue procedure that any reasonable allocation of units of unused basis to a wallet or account that holds the same number of remaining digital asset units based on the taxpayer's records of such unused basis and remaining units, provided the allocation is made by January 2025. And that certain requirements are set forth in the revenue procedures. So we can use any reasonable allocation method for the existing basis, but we need to be able to clearly have adequate records that support these basis calculations. Now, what I see happen a lot is a lot of people that are self-preparing, a lot of people that are using firms or specific tax softwares are not going to give you the detailed ending cost basis data on an account by account basis that you're going to need to use to accurately maintain adequate records to prove your reasonable allocation of units of your unused basis. So it's very important that you're able to get this data and that you're able to make this data be accurate. And for some taxpayers, it may mean that you need to go and rework several years of your accounting if the reporting and information that you have isn't sufficient for these purposes. So in addition to that, another big issue I see that a lot of taxpayers are going to encounter is that even if they have this information, oftentimes their ending cost basis data is just incorrect. It's one of the biggest due diligence issues that I see in this industry. People are doing their calculations, they're making sure their gain or loss is as optimized as possible, and oftentimes they barely even pay attention to their ending cost basis calculations. A lot of times when Camuso CPA is onboarding a new client, one of the first things we have to do is review their ending cost basis data to see if it's accurate, because it's cumulative. It factors into each year's calculation. So our starting point for a calculation is last year's ending balances. So we have to check that to make sure it's accurate for the integrity of our calculation in the current year. Most people that come across our desk that have self-prepared or even worked with another firm are not verifying this ending cost basis data. And more often than not, there's material discrepancies in it. To the degree that you have those material discrepancies, you're not going to be able to have adequate records of your ending cost basis data, and you're not going to be able to allocate it in a reasonable method. So what are you going to have to do? You're going to have to get that cost basis data accurate. And that may mean going back and reworking prior years' accounting records. So overall, taxpayers should consult with experienced cryptocurrency CPAs that have accounting and tax experience in this field, so you can get a deep understanding and advisory related to your overall portfolio, your tax positions, your cost basis, and what you need to do going forward to get into compliance and to optimize your tax positions. So if you are a cryptocurrency investor, a business owner in Web3, and you're transacting in crypto, and you're just learning about this new accounting requirement now, or you're realizing that maybe you've been misapplying this in the past and your cost basis data is not up to par for these new requirements, you need to get this in place as soon as possible. January 1st, 2025 is coming extremely quickly, and these type of accounting engagements take time. So I suggest reaching out to a qualified CPA firm sooner rather than later. And if you're looking for a crypto CPA firm that understands how to account for cryptocurrency, the tax considerations around planning and filing your cryptocurrency, look no further than Camuso CPA. Reach out to me and my team today at camusocpa.com. Schedule a consultation with us, and I'd be happy to sit down with you one-on-one to learn about your investment portfolio and your business and how we can help you from a tax and accounting perspective. So contact me and my team today at camusocpa.com. Until next time, I'm Patrick Camuso, signing off.